Hi, everybody. It's Jessica Stone at Stansberry Research, and I've got Stansberry NewsWire editor Scott Garliss on the line. Scott, you have been looking closely at the amount of money that is on the sidelines, out of the markets, out of bonds, keeping track of it. And why is that in particular so important? You did it actually 10 years ago, and now you're doing it again.
Yeah, well, it's important because that's money that's not being invested in the stock market right now or being invested in bonds. So what we've seen since the beginning of March is with fear, investors went to the sidelines. They basically went to cash by going into money market mutual funds, very small returns. So you're not losing money, but you're not really making money either. And what we saw was since the beginning of March to now, we've seen roughly $1.2 trillion worth of money go into money market mutual funds. Now, if we go back and look at the same period during the financial crisis, about $510 billion went into money market mutual funds. So we're looking at more than a double in terms of money on the sidelines.
And it's happening over a quicker period as well. What do you take from that?
Yeah, so it is happening over a quicker period. And basically what that tells me is when this money starts coming back off the sidelines, we're probably going to get a more rapid rebound. That money has just started to trickle out. What we saw last week was about $36 billion came out. When that started to happen back in the financial crisis, we saw the S&P 500 run about 461% over the next 11 years.
Wow. Where is the money going? People are taking it out of money markets, but where are they putting it to work?
So right now, that $36 billion that started to come out, we're seeing that money trickle into bond funds. Some is going into high yield, some is going into corporate grade, but it's not going into mutual funds or equity mutual funds, I should say, at the moment. Equity mutual funds are actually still seeing outflows, believe it or not. So that tells me that investors aren't focused on the stock market quite yet. And that's hard to believe with the market having rebounded 45%. But what that tells me is that money is going to start finding its way into the stock market, and that's going to mean bigger returns ahead.
Yeah. So how can we position ourselves? I mean, what's our window of opportunity here, right? If we look at the past as prologue, how long do we have to get into the stock market to ride the elevator up?
Yeah, look, I think we have a long run ahead of us. But if you want to invest right now, I would look at three things. I would look at the S&P 500 ETF, the SPYs. I would look at the NASDAQ ETF, the triple Qs. And I would look at the Russell 2000 ETF, the IWMs. If I was going to invest in one of those right now, I would invest in the Russell 2000 because companies are domestically focused, and that index has underperformed both the NASDAQ and the S&P on a relative basis. Typically, it outperforms the S&P, so now would be a great time to buy into that name.
All right. Scott Garliss, thanks for taking us through the plumbing and what it means to us of the stock market. You're always in the weeds, so we don't have to be. We appreciate it. And if you would like to see much more content just like this, please do subscribe to our YouTube channel. You can also find us at Facebook, Instagram, and Twitter. That's all for now. Thanks for watching.